Hi, and welcome to another Stuff Business Live chat. I'm Susan Edmonds, and I'm joined by Brad Olsen and Gareth Kiernan from Infometrics today to mark the publication of our latest Monitor publication. So, thank you both for being with me. How do you feel that things are going in the economy at the moment?
I feel like they're sort of kicking along all right outside of Auckland. We know that the bounce back so far has actually been relatively strong, but that's not shared across all groups. On average, card spending's up around about 6% above normal levels, so people are definitely getting some of that money out the door that they didn't spend during lockdown. Hospitality, though, is still sitting around about 25, 22 odd percent below normal levels. So we're spending at home, we're not spending out as much. And we know that although that bounce back is happening strongly across the rest of the country, Auckland, of course, still at level three, the conditions just remain incredibly challenging. But we're still upbeat, I guess, given last year's experience, given the numbers so far, that things are holding up all right.
Yeah, I think, look, the experience we had last year through lockdown has made it a bit easier forecasting where we're expecting things to go this year. Of course, once bitten, twice shy in terms of everybody expecting things to, completely fall apart with last year's lockdown, and that didn't occur. And so what we are seeing is a pretty similar pattern coming out of the most recent lockdown this time around. And so that fills us with a degree of confidence that things are going to continue to look good on the other side of this sort of breakout that we've had, and the economy will resume that sort of path of strength and tightness that we had heading into the lockdown.
Okay. Obviously, our Monitor dashboard showed really strong activity right across the board. How much would that have changed, do you think, over the last month or two?
Yeah, look, I mean, it's really hard to gauge the numbers. I think one of the issues we have with sort of estimating how well the economy is going at the moment or through lockdown is that a lot of our modelling and a lot of our sort of analysis tends to be demand based. But we know that through lockdown, most of the restrictions are sort of on people's ability to supply the market, and businesses simply not able to operate through that. So while I suspect if we come back in 3 months' time and look at those sort of monitor details, they will be weaker than they have been. That's probably just more a reflection of those supply side issues. And I suspect, you look another 3 months down the track after that, and the demand side will again be very, very strong. And we know that those issues around capacity, shortages of labour, and cost pressures, supply chain disruptions, all of those will still be influencing what will ultimately be a very strong picture, I believe.
I think as well, I mean, this is a setback, right? The economy was going in a strong position. The monitor shows that, momentum for the economy was in a great place. We really were rebuilding strongly. Businesses on the whole were certainly seeing that. And that was very broad based. Across the board, things were going all right. We sort of hit the picks, or had to hit the picks with the move to level four. And the feeling is at the moment, with these higher alert level restrictions still playing out across the country, we're having to sort of restrain ourselves, hold ourselves back because of those limitations. But you still get the feeling, with the amount of money that people have, with the interest in getting out and about, even the bounce back in Auckland at level three and spending, all implies that there's still that sort of energy there in the economy. It's just at the moment being locked out and having to be kept aside. But the feeling is still that it's going to be able to come back. The longer, though, I think that we're in these higher restrictions, the more difficult it is to get that momentum back as quickly. So it's not just sort of how energetic we're feeling, but it's how fast and swift we can get that energy back and moving.
Yeah, okay. So how urgent do you think it is for Auckland to get to level two?
I think that, I mean, of course, the sooner the better, but I think we've got to be pretty realistic that, if we do move too quick, the risk of overloading our health system could well lead to some pretty awful economic outcomes as well. And I think we've just got to be realistic. The economy is not divorced from the rest of society, from how our health response is going. If people feel confident that New Zealand has got COVID-19 under control, and that if we don't, we can at least support our society, that's going to allow people to still move around and interact in the economy as much as possible. If people get fearful, if there's a worry that they won't be able to access key services, that's where you start to see general economic sentiment start to turn negative. People are just not keen to interact as much. So it's an important move. I think the critical one at the moment is also, what does this mean sustain for the long term. A move to level 2 quickly could be great for a short-term economic boost, but longer term, if that does leave us with COVID-19, still in the community, or if it sees the overloading of the health system, that's not a great place. And it means we really need to get not only those vaccination levels up, but really start encouraging people to take some of these concerns seriously. The stat that gets me is that 20% of the eligible population across New Zealand aren't even booked in for a vaccination. That's 1 in 5 people that are completely not in the system. They're not interacting with our vaccination rollout. We've got to get to those people. We've got to ensure that they're able to and are accessing immunisation, because the more we can do that, the sooner we can free up the economy and the longer we can keep it there.
Okay. The Prime Minister's talked about how it's likely that even if Auckland goes to level 2, there'll be a boundary around the city. How much of a disruption is that for normal activity, do you think?
Yeah, I think it's probably more so at level 4 and level 3 in terms of, particularly we saw at level 4, obviously, with a lack of production and manufacturing activity across some of the sort of key industries, and particularly through construction, with everybody else moving back to level 3 and level 2 and construction activity able to take place. Yes, there were some materials available, there were some other key materials that just weren't there. But yeah, in terms of that sort of the dynamism and being able to move between regions, it will still be an issue if there are restrictions there. It just tends to slow everything down and makes everything a bit more difficult. Adds another layer of cost potentially to businesses as well if they are having to bring materials or supplies across that border. And we're already operating in an environment where there are a lot of cost pressures that businesses are facing and have been facing anyway. Adding more to the mix is just making it that much more difficult.
And some regions are really going to feel it more than others. We know that from previous alert level restrictions and the current environment that the likes of Otago and Wellington regions are often hit most by that border with Auckland. And for Otago, I think you're talking around about a third of all tourism activity comes from Auckland, which makes sense given that Auckland is about a third of the economy and the population. Wellington as well, though, relatively hard hit. You don't have those business connections that you would often have, your early morning and late night flights to and from the capital, and more workers working from home in Wellington as well, with Auckland and those higher restrictions. At the same time, I think we can't be too downbeat about how things might be outside Auckland. Northland, which is essentially in its own little bubble above Auckland, is still going all right. We're seeing spending activity there still as well coming back strongly, and I think that's a real testament to local businesses and local households wanting to back each other. The conversations we had last year about buy local and support local are just as important now as they were after the first lockdown.
Okay. This issue of the monitor, we looked at the agri sector particularly. How important has that been? We don't have tourism. Has agriculture held us up, and do you think that's likely to continue?
I mean, it's certainly been a very strong start there. We've seen a lot of dairy activity, for example, in previous times has been important. We've seen, as well as that, how important our international position has been trading out to China and the rest of Asia. But also, I think over the last 18 months, we've seen a real refocus, in a sense, on horticulture as well as sort of part of that wider primary sector, kiwi fruit and similar. The world has needed to eat. And we've been able to supply it here in New Zealand, and we've been able to supply it with some real premium products, and that's across the board. What we're seeing at the moment is still very healthy demand there. Fonterra recently reconfirmed a very strong high farm gate milk price. We're still seeing meat sitting in an all right position. Again, that horticulture activity is going well. All of that highlights that the foundations of the country, if you will, are still very focused on our primary production. But importantly, we're also not only able to make money from it, but also support our provincial economies broader. It's not just the primary sector in of itself that's keeping things moving. It's all the other connected feeder industries that are sort of, again, allowing that higher level of economic momentum. And so, look, if we're supplying the world with food, the world needs to eat, we're able to produce it. That, I think, puts us in a relatively strong position.
Yeah, those export prices are really strong across the board. And in fact, in New Zealand dollar terms, they've been at sort of 20-year highs once you adjust for inflation across all prices. So looking really good. I think the risk, and look, that's going to support incomes across the agricultural sector for the next year or 18 months at least. But the risk is that we don't want to keep on doing the same old thing as well, because there will come a time potentially where, our exposure to China, who are taking more than 30% of our exports now, that does become a risk where maybe tastes change. There's political pressures and other things which we've seen impacting on Australia over the last year or so, and their export performance and those linkages with China as well. So look, there's difficulties there for the agricultural sector, that they won't necessarily want to give up the easy gains or the revenue that's there on tap at the moment, but you do need to look at diversification, both in terms of markets, but also the products that we're selling as well. And of course, what we have seen, particularly in somewhere like forestry over the last decade or so, is just more and more logs going to China. It makes sense, because that's what China wants. They don't really want the processed timber, because they want to process it themselves. But it does leave us in a position where we are potentially vulnerable as well. So I'd be advocating for changes over time, because pushing that sort of single market and sort of lower value products has stood us in good stead, but it's not going to be there for us, I don't think, indefinitely.
Okay. Do you think we're overly reliant on the primary sector?
Well, look, it's a strength of the New Zealand economy. It's been one of our competitive advantages since New Zealand was established, I think, with, the climate that we have and other factors. Our productivity compared to much of the rest of the world in terms of producing those products has also been really good. So it's natural that we do, take advantage of those strengths. We have also seen, of course, more recently pressure to change things in terms of the environmental outcomes. And so, look, the reliance makes sense, but you just need to make sure that you're taking the longer term, some of those longer term factors into account, rather than just producing for the here and now and not necessarily thinking about tomorrow.
And I guess as well, we can never sit on our hands, and never should sit on our hands. We've got some incredible outcomes that come from the primary sector, but those have been not only hard fought for, but and hard won. But we continually try to adapt our offerings. We've seen that in terms of some of the New Zealand focuses on cheese and butter and higher export potential goods in previous times. Fonterra, for example, I remember at one point managed to cut back how much time it took to create mozzarella. We've done a lot of work in this space, and we've eked out some incredible gains. And I guess it just suggests that we again can never sort of just sit there and think that we're in a good position, because I think that's where the over reliance becomes an issue, or the focus becomes an issue, that we sort of have those concentrations. And it goes to Gareth's point around diversification as well. We're not saying we need to move away from any one good or export or country. It's that we need to be making as many friends across the world who will take our goods, and that we can trade with and interact with strongly as we can.
Okay. What's Brexit likely to mean for us there?
I mean, having been there when the Brexit vote happened, I feel like there's an interesting element of how that works from the UK's point of view. Certainly at the moment, New Zealand's trying to get some stronger connections over in the UK. We've fallen a bit behind the Aussies, who have negotiated a free trade agreement in principle. What I think we've got to be aware of as well is that the UK is moving in a very different sort of geopolitical way than they've ever done before. With their connection to the EU, there was a much greater focus on Europe itself. Now you're seeing the likes of the UK getting much more involved in the Pacific and in sort of the Indo-Pacific area. Recently, of course, interacting with the US and Australia on submarines. But we've also seen the UK start to open up a number of additional diplomatic posts down here in the Pacific. Becoming a bit more of a global operator. So there's some big changes afoot on the global settings to start with. From New Zealand's point of view, we've always maintained a very strong connection with the UK because of history. Now is the time that we really want to capitalise on that access and capitalise on that support, but also ensure that our businesses get just as good of a deal as what other countries have done. New Zealand's existed by itself strongly for a wee while, and we're certainly not going to give that up anytime soon. But again, where there's advantages for both countries, for both areas, I think we're going to look for those opportunities.
Yeah, and I think in the first instance, for New Zealand, there are opportunities there to further strengthen the areas where the UK is already a significant demander of our products. And you think of the likes of wine and lamb, for example. But if we can progress towards some sort of free trade agreement with them over time, then that does open more opportunities, which certainly, when they were part of the EU and the sort of slightly more protectionist approach that the EU generally took to a lot of that agricultural stuff, there should be more opportunities for New Zealand there over time, and again, spreading the markets away from the reliance on China that we've seen increasingly over the last 13 years.
Okay. More broadly, how's the business confidence holding up? I think we've seen some surveys this week.
Yeah, I mean, incredibly strong, given that we've been in a level 4 lockdown again. We haven't really seen much or nearly as much of an impact as we might have expected. The ANZ Business Outlook survey suggesting that actually headline confidence, I think, had improved slightly in September. The early read sort of suggested that things were holding up all right. The final read sort of supporting that view. And I think what that's showing us is, again, businesses are looking at conditions and going, look, it's an awful hit, but the feeling is that the bounce back will still be strong. Certainly the evidence so far is that the bounce back is still working its way along. And also people have been building up, in general, a buffer. So we're still seeing that confidence from businesses. And that's important, because we talk a lot about how challenging economic conditions are, and that's absolutely true. But we're also seeing that people's feeling of the economy and where we're heading next is still holding up. And that means that we're not going to get ourselves into a sort of economic death spiral. What we also do need to keep in mind, though, is that, again, those aggregate numbers are still firm, but we know, hearing from the hospitality sector and a number of others in the service sector, that times are tough, incredibly tough. And so, although, again, those headline numbers are suggesting that things are holding up, there's still a fair path to go. And the feeling is also that we'll move through this higher level of alert level restrictions quickly. If we do see an elongated tail, if things do take a lot longer to go through, you do wonder when businesses do start to change their opinions of activity, because although it's firm now, that can all change depending on what the outlook holds. And if Christmas is going to be in lockdown, for example, you could well see a very different opinion start to be formed.
Yeah, I think the degree of panic that we saw last year when lockdown hit and we really didn't know what to expect is just not there, because businesses have seen or had the experience of very strong sort of trading conditions once you come out of lockdown, an increasingly tight labour market as well. And so, by and large, businesses have been holding on to their staff, and they are expecting that demand will bounce back, as we have seen, generally speaking, in the early numbers. One of the interesting aspects of the numbers is that confidence in Auckland also seems to have been holding up pretty well, despite the fact that they have been in a more prolonged lockdown than the rest of the country. And I think that does, again, reflect the fact that, lockdown is seen to be temporary, and come out the other side of it, and demand will still be there, and people will be spending to make up for lost time. So much more even path we've seen through this lockdown in terms of confidence than we had last year.
Okay. I know the wage subsidy this time requires a drop of revenue at 40% compared to 30% last time. And we had a story today saying that some big businesses might not be claiming because they're worried about, the backlash they got last year. Do you think that subsidy is having the same impact this time around that it did last time? Is it as supportive?
Look,
I think it is, in a sense.
Sorry, Brad. I think it's there, but because, look, last time we had 12 weeks of the subsidy, the money all handed out at once, and so that was a very big impact on cash flow to businesses immediately. This time, of course, it's been more drip fed, and our argument would be, looking back at last year, that there was probably too much support for many businesses, as it turned out, because we were only in level 4 for about 5 weeks, and then another couple of weeks at level 3. So businesses were sort of overpaid that time around, and I think we saw the effects of that on the other side, where there was a lot of cash floating through around the system, not just from the wage subsidy, but other fiscal stimulus and monetary stimulus as well. So I suspect it's not quite as going to have quite as massive an impact, but it would be sufficient, particularly when you put it alongside the some of the other measures that the government has put in place as well to support businesses. That it's probably enough in this case. Whereas with hindsight, last time we would have said, well, there's probably too much money coming out there.
And I think as well, I mean, we've got to look at who's claiming at the same time. We know that at the first wage subsidy round this time, construction and the accommodation and food services sector, over 90% coverage of workers there. So that we need most did. That higher revenue revenue fall threshold, I think, is making some people question what's happening. But Susan, like you said as well, there's that reputational issue on the line, and the government actually taking a bit of a harder stance on really wanting to make sure that people are qualifying for the money before that some of them get it, particularly those larger companies. As well as that, though, we've seen that the number of jobs being lost, or the number of people at least going on support, although it's gone up, certainly hasn't gone up like it did after the first lockdown began. So the wage subsidy is doing its job in that case. And in fact, last week, when the numbers came out last Friday, we saw that job seeker support numbers rose by only 6 people. So, we're into a still relatively robust position. Weekly filled job numbers are still strong. We haven't seen any real setback there. We know as well that those labour market pressures are still quite intense. And so for a lot of businesses, although getting rid of your workers now and then not being able to find workers again out the other side is something that people are very unwilling to do so far. And we know that wage costs are up, quite considerably. Earnings per worker, I think we reported earlier this week, up 6.2% per annum. All of that says that the labour market pressures are still there. And so far, the wage subsidy has done its job of keeping people connected to their jobs. And that's critical. Of course, some of those larger businesses, though, also able to weather the storm from their own war chest more this time than last time, because of that confidence still in the economic bounce back and the position we're currently sitting in.
Okay, that makes sense. The other thing we had today was an update for CoreLogic showing that house price growth is slowing, but house prices are still rising. Do you think that's a trend for this year? Well, I mean, what's ahead for house prices after this lockdown?
I think we've got to be a little bit careful with a lot of that slowdown talk, in the sense of we always see a slowdown over the winter periods, and actually when we strip out some of that seasonality, I've got to be honest, when we've looked at the numbers, it's pretty hard to see the slowdown that a lot of people were talking about. In fact, we've now had the longest period on record since the 1990s of where house prices have risen by more percent a month, 15 months in a row, in fact, according to some other data. So I think we've got to be realistic that there's still a fair bit of heat in the market. We might be seeing some changes starting to emerge. There are certainly some fluctuations in the CoreLogic figures. We also had realestate.co.nz figures which showed a bit of a bump upwards in the amount of property supply, the number of properties available for sale. All of that could be hinting at a bit of a change, but probably a little bit early to tell yet. What is clear is that house prices are still incredibly high. It's still incredibly difficult to get, a deposit. And for a lot of first home buyers, about to get even more difficult with some of those Reserve Bank changes. The long-term outlook, and I'm sure Gareth will comment on this in a second, is very much focused around house price growth flattening out. But for the minute, the numbers we're seeing are still incredible enough to make your eyes water every month that we see them.
Yeah, one of the biggest difficulties we have at the moment trying to forecast where house prices are going to go is that there are so few properties, or there have been so few properties for sale, and we've got data stretching back about 15 or 20 years, depending which numbers we look at. And for the last decade, the number of properties that have been on real estate agents' books has been continually decreasing to the point where we've only got about 1.5 to 2 months worth of listings there now, whereas normally a decade ago it would have been 5 or 6 months. So there's very few properties for sale. I noticed stories this morning coming out where investors are saying all the tax changes are coming in, we're all going to rush out and sell our properties. Well, I'll believe that when I see it, to be honest. We may see listing numbers pop up a little bit, but they're a long way away from normal. And I think while that remains, even if you do start to clamp down on demand, or reduce demand for housing by pushing up interest rates and some of the other measures that the Reserve Bank and government have brought in, if your supply is so constrained that there's still potentially quite an imbalance there, which could continue to push those house prices up. And the only real solution, I think, is continuing to build at a rapid rate. We know consents are running at over 45,000 for new housing over the last year. Difficulty, of course, is we're probably not building at that rate because we simply don't have the capacity in the construction industry. So this is potentially an issue that continues rumbling on for quite some time, while most of the indicators, particularly slowing population growth, would suggest that the house price growth should slow in coming months. Because of those listing numbers, it's very difficult to be sure about whether that will happen or not.
Okay. Is slowing growth and more building enough to solve our affordability problem, or do we need something more drastic?
It's only part of the issue. Look, you've got house prices are unaffordable. You could drop them 10%, and they're still going to be unaffordable for most people as well, and particularly first home buyers remaining locked out of the market when you take into account the 20% deposit that most of them will need to stump up with as well. There are bigger issues around the supply of land in particular. And the supply of infrastructure for that land. And we know the government has been making, or it's working on making changes there, both in terms of sort of zoning and planning changes that are being pushed onto local councils. And we're already starting to see a little bit of that coming through, but probably more importantly in terms of the RMA as well. But gee, you look at some of those issues and you think it could be another 3 to 5 years before they start to have a real impact there. So yeah, there's a lot more around that housing affordability question than simply building at the rate we're going at the moment.
And I think realising as well that if we manage to get through the building shortage that we've talked about, all that should really do if we get through the shortage is keep prices where they are, which is incredibly high still. You'd have to build a massive excess of houses that you'd never need to use to create such an increase in supply that you've got choice that would bring down prices. So there's a real challenge, I think, there around where we head into the future. We know that for a lot of first home buyers, a lot of buyers in general, it's taking you about a decade now almost to save up a deposit. All of that is really starting to weigh on people, and it's making us change the way that we sort of live our lives. We know that particularly young people are having to wait longer in life to have kids and get married and do some of those, make it to some of those life milestones, because they're taking longer now to get on the housing ladder. And you've got these massive wealth inequalities that start to bear out, and as inheritances start to flow through, the wedge between the haves and the have-nots is going to grow. But I think Gareth makes quite an important point that we've got to be thinking a bit more longer term. If we got ourselves into this position with housing now, if we only solve the symptom, then we could well find ourselves in the same place in 20 years' time if we haven't fixed the underlying cause. So getting our planning right, making it so that you don't have to, jump through every hoop imaginable to build a house, and that you can actually get things moving quickly. We've got quality infrastructure. All of that's going to be critical to not only today's success, but also future New Zealand being able to have a housing outcome that is actually something we can be proud of, rather than what we've got at the moment, which is the complete opposite.
Okay. How much of a risk do you think first home buyers are taking at the moment with interest rates rising and more rules coming in? Are they overexposed?
I mean, there's a fair amount of cash that we've currently got into that first home buyers market at those, what the Reserve Bank is terming risky levels. Now, remembering, of course, that interest rates are low at the moment, but a mortgage is a 30-year commitment for a lot of people at least. And so I think we've got to manage that risk, and we can't bury our heads in the sand. I don't think we need to go to the extremes of saying, look, there's well, and in fact, the Reserve Bank isn't proposing to go to the extremes of saying at a certain, risky level, just no one can get money. It's trying to manage just how much in the single mortgages are quite massive relative to their incomes. So are we being prudent? Yes. Is it going to hurt? Absolutely. First home buyers are certainly going to feel it a bit more in terms of that lending access. But I think we've also got to be realistic that given where we currently are, if you did have a high number of those indebted first home buyers that start to get in a bit of strife, that's a pretty huge hit to them personally that could come through. And I guess that's what we're trying to manage. I guess the trade-off here, right, is that you've got to balance ensuring that people can get into the housing market, which is important for young people, but also ensuring that they're not so loaded up that they're burnt at the first sign of trouble. That's also not a great outcome for young Kiwis.
The mortgage rates that banks have been plugging into their calculations haven't got below 6%, as far as I'm aware. So while we've had fixed mortgage rates down at 2.2%, 2.3% earlier this year, banks are still looking at you when you ask for a mortgage and apply for a mortgage and say, well, can you service this mortgage if the interest rate would have spiked back up to 6.2%, 6.3%, which nobody is forecasting within the next 5 years when we look across the sort of range of economic forecasts for New Zealand. So in that regard, I think, people getting into the market are generally going to be able to service that mortgage and keep on going. Hopefully over the next few years they'll be experiencing some income growth as well, which will start to ease some of that pressure. But let's be realistic, it is a large proportion of your income that you are having to devote to servicing the mortgage if you're getting in as a first home buyer at the moment. And the scope for house prices to rise from here, we talked about some of those sort of near-term issues, but in reality you are paying a pretty high price for that property, and so the sort of capital gains or the value of that asset that you're left with over time might not be, it'll still be good, but you're not going to make massive gains on it probably compared to someone who would have, bought back in the early 2000s. So there are issues there for first home buyers, and I think their budgets will be squeezed as interest rates do rise, but not to the point where it's going to cause a wholesale collapse or a big lift in the number of people who are being forced to sell their properties.
We've run out of time. So thank you both very much for joining me. I really appreciate it, and all your work on the monitor.
Thanks, Susan.
Talk to you again soon.
Thanks for having us.